Hey, good afternoon. I'd like to take this opportunity to welcome everyone to today's webinar, Sneak Preview Model ETF Portfolio. It's Monday, July 11th. You got John Hopkins here, Tom Bowley, gonna jump in just a minute. If you're new to Earnings Beats, I wanna take this opportunity to thank you for taking the time to stop by today. Hope you find this of value. Of course, we wanna thank our wonderful existing members. Many of you have been with us for years, going back, some of you, to the early days, 2004 and 5. So quite a long relationship. Really appreciate it. For those of you unable to stick around for the entire event, not a problem. We record all of our sessions. As a matter of fact, we've got quite an extensive educational library that we've developed over the years on so many different topics. Those are available to our subscribing members. Now, one thing I want to mention, we've got a number of webinars coming up over the next couple of weeks, including starting tomorrow, one of my favorites. It's our Options Max Pain webinar, where Tom will be looking at the major indexes, including the NASDAQ and the S&P, and then some individual stocks that could be potential short-term, long or short trading candidates based on Friday's monthly options expiration. And, with today's action, I'm going to be very interested tomorrow because we've had some nice gains lately, but now we've got a bit of a pullback here. It's going to be interesting to see where the max pain is, where the market makers want the major indexes and some of these individual stocks to end up come Friday to lower any out-of-pocket money they have to pay. And I know the last couple of months have been pretty amazing. And we'll be talking about that tomorrow, but you've got to be a subscribing member. That includes taking out a free trial. You go right to our website, earningsbeats.com, take out a free 30-day trial. You'll get into that event tomorrow for free. It's worth it to just be in on that one. And then the next week, we've got our Q2 earnings sneak preview event, and that'll be followed by the Q2 earnings webinar, which is also going to be, I think, fantastic. So anyways, if you're not currently a subscribing member, consider taking out a free trial, and you'll be able to get into all these events coming up over the next couple of weeks. All right, with that in mind, let me see if Mr. Bowley's in the house.
How's it going, John? Good afternoon, everybody.
Good. I'm always happy to hear your voice.
Sure you are.
I'll tell you something, this market, we're kind of cruising along a little bit off of what I call the bully bottom. And then Monday comes along and just kind of got smacked around a little bit today.
Yeah, I wasn't overly shocked by it. I mean, we did close a little bit below the 20-day EMA. So unless we get a quick recovery tomorrow, I mean, I actually got a little bit, I had a little leverage today trying to go with the QLD, thinking that maybe we would bounce off that 20-day EMA, but it didn't work. And so I ended up getting back out of it short term, just, see what happens with the market. But it is Monday. And for those that are new and really don't, and aren't familiar with historical trading tendencies, Mondays, we've had a minus 14% annualized return on Mondays since 1950 on the S&P 500. So that's pretty significant departure from the way the rest of the week normally trades. So Mondays, you have to be a little bit careful. And last week, we ended up very close to the 50-day moving averages on some of the key indices. So I'm not surprised we had a little pullback today. And of course, for me, it's not so much about whether we're going up or down. It's about trying to look at what's taking place in terms of rotation. And today's action did about what we normally do when we see the market pull back. We saw rotation more into defensive areas and value-oriented companies and more away from aggressive or growth-oriented companies. So all in all, I thought, maybe it was to be expected after the nice rally we'd had recently and where we were technically on the chart. But I think it's a little early to read too much into it in terms of how far we might drop. We'll kind of play it by ear as the week unfolds, and we'll see where we go.
All right, I'm going to go ahead and step aside because I know you want to get rolling and have a good event here.
All right, sounds good. Again, I want to welcome everybody for stopping by. Tonight's event is the Model ETF Portfolio Sneak Preview. The portfolio, we've been doing this now, I don't know, maybe for 7 quarters. I think the next quarter will be our 8th quarter, which will make 2 full years. And throughout the last couple of years, we'll talk a little bit about results, but the last 2 years, or really since we started this, we're trailing the S&P 500 by a couple of percentage points, but we got swamped 1 quarter. It was back January of 2021 versus during the January 21 to April 2021 quarter. That 3-month period where money rotated completely away from growth stocks, we ended up trailing the S&P that 1 quarter by 8 percentage points. So outside of that 1 quarter, we've actually done really well. The last, I'll go through some of the numbers here in just a couple minutes, but what we're trying to do here with this event tonight is just kind of give you an idea of how we go through and approach the market, what we look for in terms of putting together a portfolio that we design to beat the S&P 500. That's the whole idea. And we've been able to do it most of the quarters. I think this will be the 4th time we've outperformed out of 7. So I think that's pretty good. Let me see, 1, 2, 3, 4. Yeah, this will be 4 out of 7. So we've done it more often than not, assuming that we hold up over the next, we have about a 3.7%, I think we're down like 9%, market's down about 12.6%. So unless things really fall apart for our model ETF portfolio, we should easily outperform the S&P 500 again this quarter. And that will make it 4 out of 7 quarters that we've outperformed. And like I said, we had the 1 really bad quarter, but everything else has been pretty decent, kind of what we would have expected. Anyway, I'm going to talk a little bit about how we put these together and some of the things that we consider. We've got a really cool ETF Analyzer feature that we have on Excel. I'll go over and show you that a little bit. Even if you don't follow our portfolios, it's a really neat tool to use if you like to trade ETFs, just so that you know a little bit more about what you own. And that's what I always talk about when I talk about ETFs, because a lot of times folks will throw out an ETF like it's a stock, and it's really not. An ETF is made up of a lot of stocks. And some ETFs may say that they're technology. You might think that they're all technology based on the name of the ETF, but it may turn out that 25% maybe is in other areas. Maybe it's in energy, or maybe it's in, communication services, or some other, maybe it's financial technology and it's more considered financial. Anyway, the point is, a lot of times you own ETFs and you think that they're one thing and they may be something else. But we'll go through and I'll show you that analyzer. But let's go ahead and go through the agenda real quick for tonight or today. And we're going to start off with the bear markets versus bull markets. I just want to show you how many of the sectors and the major indices perform relative to one another during bear markets versus bull markets. So it's really important to understand which one of those you're in. And I think there's some confusion right now in the market. Are we in a bear market? Are we in a bull market? Well, I think we're in a secular bull market, long-term bull market, and I think we're coming out of a cyclical bear market. So I think the short-term weakness has ended, and we're going to resume the long-term bull market. That's my belief. We'll go through current themes, talk a little bit about what's going on in the market right now, some of the things maybe to think about when you start to put together a portfolio of ETFs, then go through sector and industry analysis, looking at rotation. Where's money flowing? If we're looking to outperform the S&P 500, we need to know what's outperforming on a relative basis, where money is starting to rotate to, or where it's been rotating to. Then we'll talk about that ETF Analyzer, and then give you a quick and dirty analysis of what we'll do for the draft, which will be next week. So if you are new to Earnings Beats, we do these drafts. We have a model ETF portfolio, which is what tonight's session is all about. And this draft occurs every quarter but we always do it. We don't do it at the same time we do our stock portfolios to kind of keep it separate. But we do these on January 19th, April 19th, July 19th, and October 19th. So really just about the time earnings season kicks off. That's when we, because we're starting to see a lot of the relative strength. We kind of know where the money is rotating to heading into earnings season, which I think is really important. And so the timing, I think, is best as we begin to kick off earnings season. So that's one of the reasons why we do it this time of the quarter. But we hold these ETFs, whatever ETFs we end up drafting for our portfolio, we hold them for 90 days until April 19th. Now, because of the crazy rotation that we have seen over the course of the last year, maybe year and a half with the pandemic, and then with the cyclical bear market this year, there's been tremendous rotation, which has presented a lot of obstacles and challenges. And that's, probably going to continue a little bit, I think, throughout the rest of the year. Although I think we're going to see more of a shift towards growth as we get later into the second half of the year. Could be wrong. I make my calls, my thoughts, my predictions, and they're out there for everybody to kind of pick apart, or maybe I can celebrate them later. Sometimes they're right, sometimes they're wrong. But I just go with what I see, and I don't try to sugarcoat anything. If I believe the market's going down, I say it. Normally, I'm going to tell you I think the market's going up because normally the market goes up. So it's going to be just those exceptions when I get more bearish, like I have in 2022. But anyway, we'll talk a little bit more about the draft at the end, and that will be held next week. So we've got another week or so to go before we actually have the draft where we talk about which ETFs are going to be in our portfolio for the next quarter. All right, let me go ahead and get going with this. I do think I can probably get through everything within an hour. So I'm thinking by 5:30 Eastern. If for any reason you all need to leave, anyone needs to leave and you want to come back, we are recording this. So you can, come back at your leisure and check this out later. If you can't stay, that's fine. If I can get it done quicker, I'll get it done quicker. I just don't like to leave things out. I know a lot of you are new to earnings beats, and I just want to make sure that I try to cover as much as possible in terms of the details. As John mentioned, we do have a no-cost 30-day trial. It's completely free. You have to give your credit card. That's because we need it for our system to bill if you do elect to stay at the end of 30 days. But and by the way, after your 30-day free trial period is up or right before it ends, we'll let you know. So we're not going to hope that you just forget about it. We'll let you know. We don't want you to be a member and have to pay unless you believe in what we do and you think we're a fit. So we'll let you know. But here is a way you can start your 30-day trial. Go to earningsbeats.com. Right here in front of you will be your no-cost trial, that button. You can start it by hitting that and then just following through. Just want to make sure everybody's aware of that. All right, let's talk a little bit about the model ETF portfolio. And I want to start off with bear markets versus bull markets. I take this for granted, but some of you may not be aware. So I have first off here a chart really since 2013, because to me, that's when this secular bull market began. I know you're probably going to look back and say, well, no. It started back in March of 2009. And my answer would be, oh, you mean like the one back in 2003, 2002, 2003, when we ended that bear market? We never broke out above the early 2000 high on the S&P 500. In 2007, we went right up to it and we failed and back down again in another nasty bear market. So you don't actually break out of secular bear markets, in my view, until you clear the prior highs. I mean, yeah, we can look back with perfect hindsight and say the bull market began March of 2009. But who is to say that we didn't just go back up to 1,500 on the S&P and go back down again? We'd already done that twice. So you don't really know, you don't get confirmation until you break out above the 2000, 2007 high. It's just like a stock. If you're trading a stock and it's in a trading range from 90 to 100, do you want to buy it when it gets to 99? Do you know for sure that it's going to go through? No. I mean, it may go back to 90 again. So you're in a range until you actually get that confirmation of a breakout. We got that on the S&P 500 in April of 2013. When we went through, it was probably right around the 1560 area, 1570, something like that. I don't remember exactly where we were. But anyway, we made this breakout. And so what I wanted to do first is just show you that from this breakout, the date of this breakout, April 10th, 2013, through this high in 2018, which I think was right at the beginning of October of 2018. That's when the trade war, we had this trade war related cyclical bear market that went on for 3 months. There it is. Well, I calculated these different ETFs and indices. I calculated the returns from the beginning of this secular bull market right up until we started, right up until the top before we had this cyclical bear market. And these were your returns. So from here to here, the S&P 500 gained 85.16%. Over that same time frame, the NASDAQ 100 went up 168%, which was almost double the S&P 500. The IWF, which tracks, large cap growth names, rose 134% during this period. The IWD, which tracks large cap value names, was up 76%. Again, you can see very significant outperformance by growth stocks over value. And then I'll give you 3 key aggressive areas, sectors: technology, communication services, and consumer discretionary. Look at their returns: 174%, 147, and 133. All 3 of these way above the S&P 500. Meanwhile, the defensive groups, utilities, 61%, staples, 55%, real estate, 53%. All of these are well below the S&P 500. So the S&P 500 is just this blended, big universe of 500 multinational companies that reside in 11 different sectors. So when you go with the S&P 500, you're heavily diversified and in many different areas. And if you didn't know anything about the stock market, but you wanted to invest, which I would hope that you would want to do, because I think this is a great way to invest your money over the long term, you would simply get into the SPDR, the SPY, which tracks the S&P 500. Because over this period, you would have, in 5.5 years, you would have made 85% on your money in the S&P 500. Now, if you had recognized the breakout and started thinking, okay, this is a secular bull market, I want to be in more aggressive areas, I'm going to get into the QQQ, which tracks the NASDAQ 100, you would have made twice as much as you would have made on the S&P 500. Had you been into sectors, the more that you had weighted towards these aggressive groups and the less you would have weighted toward these defensive groups, the more money you would have made. So when you're in a secular bull market, my point here is that if you're putting together an ETF portfolio and we're simply just looking at the sector ETFs, if you believe we're in a secular bull market, you want to be overweighted even more so toward the XLK, XLC, and XLY in order to outperform the S&P 500, because that's the history of the market. When we're in a big move to the upside, we're in a secular bull market, you want to be in the growth areas. The reason that we're in a secular bull market in the first place is because the stock market, that asset class, is favored for an extended period of time. It's what I call super cycle, bullish super cycle of being in stocks. And during that period, the more aggressive stocks are generally going to perform better, because during the period when the S&P goes up, this is one of the best leading indicators of economic activity. When the S&P 500 is going up, it's normally because Wall Street sees blue skies ahead in terms of our economic activity. And as a result, we tend to rise based on that economic activity. Well, those that can grow their earnings faster, like growth-oriented companies, are going to outperform. So that's what we look at during bull markets. Now, I also highlighted these 2 cyclical bears. One being back in 2018, fourth quarter of 2018 during the trade war. And you can see the S&P actually did a little bit better than the NASDAQ. This time, the more aggressive areas underperformed. And if you look at growth, IWF versus value, IWD, growth did worse. If you look at the aggressive groups versus the defensive groups, aggressive groups did worse. So when you see a potential cyclical bear market coming, you want to reposition. You don't want to be overweight XLK, XLC, XLY. The reason? Because they underperform in a bear market, cyclical or secular. But in this case, I was only looking for cyclical. Even in this pandemic, I was looking for cyclical. And now I'm looking for cyclical. I believe we are going to rebound out of this similar to the way we did in 2019 and similar to the way we did in 2020, coming out of these cyclical bears. But during the period when you're going down, you really want to minimize your losses if you're going to stay fully invested. Now, again, we're talking about being invested 100% at all times. That's what we do in our portfolios. We don't make trading decisions. If you're deciding, oh, I want to go into cash, let's go into cash. Well, you're not buy and hold. You're now starting to make trading decisions. These portfolios are more based on those who want to be invested, but don't want to have to deal with trading stocks or ETFs every week or every few days or even every month. All we do with these portfolios is adjust them every quarter, every 90 days. That's essentially what we do. So when you're going into these periods or when you're in these periods like we were the last 6 months, you can see here, this is what we've been doing. This is through Friday's close. So year to date through Friday's close, the S&P 500 down 24%, NASDAQ down 33%, growth IWF down 32%, IWD value down 18%. And then look at the aggressive groups, down 30, down 32, down 36. That's technology, communication services, and discretionary. And then utilities, staples, and real estate did better, although real estate, you can see, hasn't done great this year. But utilities and staples were both much better than these aggressive groups. So how do you beat the S&P 500? You beat it by moving away from the XLK, XLC, XLY, and putting more money into defensive areas. That's what we did. That's what we've been doing in 2022. And our year-to-date 2022 in the model ETF portfolio is down 12.38% through Friday. And you think, well, yeah, that's not very good. Well, the S&P was down 18.19%. So we've been fully invested, and yet we've outperformed the S&P by almost 6 percentage points year to date. And it was because, based on all the clues that we had in terms of rotation, sentiment, and everything that we look at earnings beats, we had clues the market was going to struggle this year. I wrote about it, talked about it at the beginning of the year. Believed back at the end of December that we could be staring at a cyclical bear market before we ever even went down a point on the S&P 500. And sometimes I'll get questions from members, and they're like, well, why aren't we in cash in the portfolios? Again, the portfolios are not designed for trading. Portfolios were designed back when members wrote to me a few years ago and said, I don't want to trade. I love what you're doing. I love what you're talking about with relative strength. I want to participate, but I want to remain invested. I don't want to, pick and choose and try and time the market in terms of trading all the time. And deciding to get into cash and then using cash and getting back into cash, those are trading decisions. They're not buy and hold. And I've had some say, well, yeah, you can still have cash positions even when you're buy and hold, you make certain allocations. And what I would say is this: if you've got an allocation where you want to be 20% cash, 20% bonds, 60% equities, I would be looking at our portfolios within that 60% that you're considering. You decide how much cash you want to have based on our guidance or based on, whatever it is in your own risk profile that makes you want to have a certain amount of cash. That's fine. But you should be looking at our portfolios, and we're not registered investment advisors, by the way. I always like to point that out. I'm not a registered investment advisor. Earnings Beats is not a registered investment advisor. No one at Earnings Beats is a registered investment advisor. So we're not licensed to give you advice on what you should do with your money. We're not licensed to tell you how to manage your money. Everything we do at Earnings Beats, we're trying to educate. All the things I've learned over the years, I got a lot of what I've learned. I picked up a lot from John Murphy. I'm also very much self-taught. I do a lot of analysis on my own. I think it's just my background being in public accounting for many years. I like to analyze. And so I've taken a lot of the stuff I learned from John Murphy, and I've just taken it to what I think is another level, couple levels. And I continue to look for anything that gives me an advantage over the market. And I share those things with our members. That's the whole idea. So it's not so much that I'm going to hand you fish, but I'm going to teach you how to fish. That's literally what we try to do at Earnings Beats. Anyway, that's just a little bit of background on, bull markets versus bear markets. Let me show you the 1980s and 1990s. Here's 1980 and there's 2000 right here. So this is 20 years of the S&P 500. That would have been a great time to invest, right? S&P 500 went up 1,431% in 20 years. That's nice. The NASDAQ went up over 3,000%, more than doubled the S&P 500 from this low right here in 1982 to this high at the beginning of 2000, that 18-year period. S&P did great, but guess what? Growth did a whole lot better. And there are growth stocks in the S&P. It's just the NASDAQ is more growth oriented. Not nearly as many what I would call value stocks in the NASDAQ or in the NASDAQ 100 especially. Now, this was the NASDAQ, not the NASDAQ 100, because the NASDAQ 100 index didn't start, I think, until sometime in the mid-1980s. So going back to 82, I needed to use the NASDAQ index because that began, I think, in 1971. Anyhow, the point here is one thing you have to think about when you're putting your portfolios together is, do you believe that we're in a secular bull market going higher, or do you think this is a secular bear market going lower? That's going to make a major difference in how you construct your ETF portfolio. When we put ours together, I'm going to put it together based on what I think we're in. I think we're in a secular bull market. Now, I saw signs this year that I believed we were in a cyclical bear market for a period of time, and I took necessary precautions with these portfolios. We were much more defensive. We came out of growth pretty early on. I want to say it was probably back in the January 19th. So it's probably been 6 full months. That's the reason why we're up on the S&P 500 6 percentage points this year. Not that we're making money in the portfolios, but we're helping conserve for those that want to stay invested, helping to conserve during a bad period. But I can tell you next week when we pick these, they're going to be much more growth oriented. Unless something really horrible happens between now and next week when we do the draft, which I think is next Tuesday. Unless something horrible happens, we will be much more invested in growth for the next quarter. All right, the other thing I just like to point out, this is the long term. This is a 100-year chart of the S&P 500. And for those of you that maybe don't understand secular bull market versus secular bear, this is just a great visual way of kind of comprehending what I'm talking about. Back in the 1930s and 1940s, you can see coming out of 1929, we had the crash. Look at these two peaks, these two twin peaks right here in 1937 and 1946. We cleared that in the early 1950s. And once we cleared that double top, you can see we had 2 decades of strong S&P 500 action, secular bull market. We had some cyclical bears in between. We had recessions. Don't think, that's part of what I think confuses a lot of folks is they start hearing recession and they think the Great Recession of 2007, 2009. That's not a normal recession. We've had maybe 3 of those in my lifetime. 1973, 74, 2000, 2003. and 2007 to 2009. That's when we've had those really bad ones. But since 1950, we've had 11 different bear markets, and 8 of them are cyclical. And that's what these little short, brief ones are. That's 1987. There's 1990. That's the Persian Gulf War. 1998. Then we go through this period, 12 years, where we can't, there's that double top I was talking about. So a lot of people say the secular bull market started in 2009. My response is you didn't know it was a secular bull market until you get the breakout. Doesn't mean you can't be long. I'm just saying it didn't start the clock on this secular bull market till it makes the breakout. That's when you know you have a secular bull market. So we got this breakout. Normally they go on for about 2 decades. We're 9 years in right now. This one, 1981 or 1980 to 2000, 20 years. Here, 1951 to 1969, almost 2 decades. I think we're still very early in this move. The other thing I find pretty interesting is 1987. This kind of big collapse that we had was about 8 years, 7 or 8 years in to the secular bull market. The pandemic was very similar. It was about 7, 8 years in, where we had the 1 month crash, and we rallied back up, had another bear market a few years later. We rallied back up, had another cyclical bear market 2 years later. History does kind of repeat itself, but I still think long-term we're in this secular bull market. So I think this is going to turn out to be a blip, not a big, long extended move down. Feel free to disagree. I'm just giving you my opinion based on my analysis, my research, looking at what the market's doing, how money's rotating, all of those things. I believed at the beginning of the year, this was going to be 3 to 6 months. I think it turned out to be about 5.5 months. I think it ended at the end of June or middle of June. We'll find out. If it goes lower, I'll say, hey, I was wrong. That bottom didn't work. And we'll see, what all the other rotational issues look like at that point. But anyway, that is, bear markets versus bull markets, secular bear versus secular bull. I just want you to kind of understand the big picture when I start to put these portfolios together. So now that we've kind of gone through what I think is a cyclical bear market, and I think we're going to start to turn back up in the second half of the year, I'm going to want to be much more aggressive because I know during advances, the NASDAQ, the growth areas do better. They've been doing better since 2013. They did better in the 1980s and 1990s during the last secular bull market. It just makes sense. Growth stocks. And I used to do valuations when I was in public accounting. When you've got growth stocks, you're basically taking future earnings growth and you're discounting it back. Companies that can grow their earnings faster are going to get bigger valuations than companies that grow at a slower rate. That's fact. I can tell you that is absolute fact. Valued companies, it's really an important component of valuations. Earnings growth rates, anticipated earnings growth. So when these companies are beating estimates and raising guidance in a secular bull market, that's what causes the NASDAQ to do what it does relative to the S&P. All right, let's move on. I want to go into some of the current themes. So back at the beginning of the year, when I turned very cautious, very bearish, and those of you who've been members for a while, you're going to see some familiar charts here. S&P 500 end of the year was rising. 3 sustainability ratios. I'm just going to focus on 3. I have a number of them that I follow, but I'm just going to go over 3. XLY versus XLP, consumer discretionary versus consumer staples. Which is outperforming? I can tell you that there's probably no better intermarket relationship that correlates with the S&P 500 any stronger than this ratio right here, XLY, XLP. When this is going up, I'm bullish. When this is going down, I'm bearish. It's pretty much that simple. Maybe with a few exceptions, but for the most part, when I see the S&P go up and this ratio start to go down, Wall Street is reallocating its resources, and it's not doing it in a bullish fashion. You have to be aware of that. QQQ versus a spider. I just showed you secular bull markets. The NASDAQ outperforms the S&P 500. So why in the heck, when we're going to new highs, would we see this ratio go down? Well, Wall Street is reallocating its resources into the S&P relative to the NASDAQ. That's not good. And then growth versus value. This is large cap growth, IWF, versus large cap value, IWD. Once again, market moving higher, breaking the new highs. Why in the heck would we want to get out of growth? Well, because Wall Street was getting out. That's why. You know, I don't have an MBA. I'm not nearly as smart as all the people that get hired at these big Wall Street firms. I mean, these are folks coming from Harvard and Princeton, Columbia, Yale, Stanford, Duke. I mean, you take the finest institutions in the country and even throughout the world. That's where they're hiring their people from. These are brilliant people. And when they start moving their money in a certain fashion that makes no sense, I take notice. I may not know everything they know, but I can read a chart. And as far as I'm concerned, that's all I need. Now, on the way down this year, all these ratios have been going down. That's why I call them sustainability ratios. It means that the downtrend is very sustainable because these ratios keep going down with them. Well, when we get a low like we did at the top where we had a high with all these turning down, one of the things, and I said this earlier this year, one of the things I was looking for was price action to go lower and these relative ratios to turn back up. And that's what we're seeing. Now, if the market weakens here and we start seeing another big drop in the S&P and these ratios all turn and go to new lows, I am not going to be as bullish as I am right now. And I'll be saying, hey, let's cool our jets here for a little bit. Let's kind of watch things. If you got really aggressive on the long side, you don't want to be at that point if we start to break back down again. But I'm not going to get out worrying about it. I mean, the market's telling me that money is rotating. So that's what I'm going to react to. And that's why I'm long the market. So, you know, when we're talking about themes, this is a big one for me. Wall Street is moving in a different direction. Wall Street is saying they believe it's better to be in growth stocks than in value stocks, even though the S&P went and set a new low. The exact opposite of what they said at the high. I would say that that was a pretty good signal. Is this going to turn out to be a great signal? We'll know later this year. Nothing is a guarantee. I will always say that. I've had stocks, I've had trades set up where I was like, man, this thing can't possibly do anything but go up. And then it goes down. It's just, you know, it's all about managing risk and knowing when you want to take additional risk, when you don't. I think when you start seeing signs like we saw in June, that's when I want to start taking risk. That's when, in my opinion, it's riskier to be in cash than it is to be long. Because if the market rebounds like I'm expecting it to, then what do you do? After you've been in cash and you watch it jump 10%, 20%. I know what you do. I've been there before. You sit there and say, well, when it goes back down to that level, I'm going to get back in. And then it pulls back a little and you're like, okay, here it comes, here it comes. And then all of a sudden it goes to another new high and you're still sitting on your hands. It's a very difficult, when you're being directed by what the stock market is doing, you're in trouble. You've got to make your decisions, I think, independent of the price action. You need to be looking at these relative charts, number one. Anyhow, that's definitely a theme that I'm looking at right now. 5-day moving average of the equity only put call ratio. This is a sentiment indicator I like to use. Look back at every single bottom on the S&P 500 that is meaningful at all. And you're going to find a 5-day moving average of the equity only put call ratio that hits right about that 0.8 level. Might go higher. I mean, when the fear really gets extreme, you go higher. But normally when you look back, when you hit that 0.8 level, you are essentially putting in bottoms almost every single time in the market, almost every low. You've got to have sentiment reset. When you're selling off, you want sentiment to get to the point where everyone believes the market can only go down. And when you get to that point, the market goes up. Sentiment is a contrarian indicator, and it's so important when you get into these bear markets. You know, I remember on the way down, I would read articles where folks were saying, oh, it's going to come up along this support level or this support or this support. And it just kept working its way and going lower and lower and lower. You don't find bottoms in bear markets until you reset sentiment. Sentiment marks bottoms. You've got to have that feeling in your stomach like you can't take the stock market anymore. When you get to that, and then maybe get to that point on steroids, that's when the market bottoms. The other thing, and this I talked about back at the Market Vision 2022 event back on Saturday, January 8th. This 253-day moving average of the equity-only put-call ratio was just starting to turn up. And when it turns up like this, the market doesn't do well. It either goes down or it goes sideways, or it's sideways. In here, it was just crazy, all this up and down action, you know, when we started to turn up. But we had gotten to a point of bullish sentiment that we had never seen. The post-pandemic bull market brought on a lot of new traders that had no idea what a cyclical bear market, what any kind of a bear market looked like. They didn't know what a correction looked like. They barely knew what a pullback looked like because we went up almost continually for 2 years. And so those in the options world, everybody thought this was an easy ATM machine. That's not the way the stock market works. And unfortunately, it's got to become a very painful lesson before you can mark a bottom. Everybody thought crypto was going to go through the roof and to the moon. All these different cryptos, Bitcoin, Ethereum, Litecoin, but Dogecoin, all these different coins. I would say the majority of folks investing in them probably couldn't even tell you what they were, explain how they work. And yet they were putting tremendous amounts of money thinking these just go to the moon. They'll just never come down. Well, we're seeing what's happening now. We're getting some crypto hedge funds that are going under. Even the professionals, or so-called professionals, were taking risks they had no business taking. Why? Because of this bullish sentiment. Everybody thought we couldn't do anything but go up. Well, once that started turning up at the beginning of the year, that was pretty much all she wrote. And there you can see what's happened since. So now we're in the process of resetting sentiment. And that's what I suggested back at the beginning of the year. We needed to reset sentiment. We needed this line to form. Unfortunately, for this line to form, there were going to be a lot of people in pain with their stock portfolios because sentiment doesn't get reset when the market keeps going higher. Who's going to get bearish if you just keep making money on the long side? The way you get bearish is just to repeatedly get thrashed out behind the barn. That's how you start to turn bearish. When you get to the point where, oh my gosh, the only way to make money is to be a bear. And then you start turning and you start buying puts. We're going to top. We're not going to go all the way up to these tops. We're in a secular bull market. I think we might get to here though, 0.575. And I think even after market bottoms, which I think it already has, I think we'll continue to see this go up because it just takes a little while for this to turn. I mean, the bearishness only began the last 6 months. This is a 1 year moving average. So it's still 6 months of this is still at the end of last year. So as we go forward, we'll be replacing the second half of last year, which was really bullish, with readings that aren't going to be as bullish as those. And so we'll probably still see this go up a little bit more. I'm thinking 0.575. I mean, we could get to 0.60. I don't know if we get that high or not. But anyway, the point is we are resetting. We've had so much pain in the market. Now everybody thinks with all the bad news and all the media pretty much brainwashing us, telling us that things are so horrible that we'll never recover from it. and that we're going to have runaway inflation and oil prices, and who knows, they might be $200, $300 a barrel at some point. It's going to be awful interest rates. It's going to be the 1970s all over again. I mean, that's what everybody wants. That's the picture we want to paint. And so you hear that enough, you hear it for several months, and you start believing it. And then you start getting really bearish, and you start saying, well, I'm going to just jump all over these puts. That's the way to make money now in the market, puts. I saw something today. This was on CNBC. You know how if you ever over at CNBC.com, they have the little pro thing next to the article where you can't read the article unless you're a pro subscriber. So they basically try to gouge you into paying them even more money to be a subscriber. And I say that loosely because the article was, I think it was ISI, or there was some portfolio management firm, I don't know, that was saying, I'm trying to think, I put it in our daily market report today. Let me see. I didn't put that in there today. But it said something like they were lowering their that's what it was. They were lowering their S&P 500 target. And I'm thinking, and you're going to charge people for that? The S&P 500, which is already in bear market territory, down 25% from where it was 5 or 6 months ago. And now you're going to lower your S&P 500 target, and you're going to charge people to read the article. Yeah, let's give them all a golf clap. Great job. I don't make this stuff up. I just read it and just shake my head. Anyway, we're now getting reset on sentiment, and we're getting to the point where we could launch higher at any point. Maybe it started in, that June low, maybe on the S&P. Maybe we're going to go a little bit lower. Who knows? I think I've seen enough signs where I think the bottom could be in, which is why I made the call I made. We'll see. Consumer prices. We're going to get inflation numbers out later this week. Going into the draft, we want to at least know what's going on with inflation. You can see this is the monthly readings on the consumer price index core. And then down here's the 12-month rate of change. So that's giving us our annual inflation rate, which is right around 6% right now. I said back at the beginning of the year, we'd top around March. And that we got to 650 after March. And now we've started coming back down. I think if we're going to go above 650, I think it's going to happen in the next 3 months. July, August, September readings, which will come out in August, September, and October. Those are the 3 months that we could go back up and challenge the 650 level, maybe go just slightly above it. And then I think it's over. I'll show you another chart with gold here in just a minute. The other consumer price index chart I wanted to show you, this is just a 3-year chart. So the other one went back a long ways. This is just the last 3 years, showing you the monthly movement readings. The reason I think July, August, and September could go up is if you look at July, August, and September of 2021, we had very slight increases in CPI. Down here at the bottom is the 1-month rate of change. So this is telling us what CPI did each month. In July of 2021, it rose 0.3. This is core CPI, rose 0.3, 0.2 in August, and 2.5 or 0.25 in September. So this year's readings in those 3 months could come in higher than those 3, probably will. And so when you're looking at the annual rate, all you do is you add up the last 12 months. So if we get rid of 3 months that really didn't show much increase, and we add 3 months that show more of an increase, then our 52-week high, or it could be in jeopardy. This annual inflation rate definitely could turn back up again. So I think it might go back up. And I think when people look at it, they're going to be thinking, why is the stock market going up while inflation's going up? Why is everyone moving into growth stocks? It won't make any sense because inflation's going to be on the rise. But by the time we get past September, then we start seeing these bigger jumps again. And with what the Fed's doing with interest rates and a potential recession, I don't think there's any way we're going to see prices jump like that later this year. In fact, I wouldn't be surprised to see CPI go negative later this year or early next year. Core. I wouldn't be surprised to have a couple of negative readings because I think we're going to go too far. And I think we're going to have an oversupply, not enough demand. And I think we're going to start seeing inflation going the other way. Just my thoughts. Gold. So I want you to look at when we really had an inflation problem back in the 1970s. So here, I want you to look, this is the CCPI, core CPI on an annual basis, jumping from 3% to 12%. Look at gold relative to the S&P 500. Then we came down, gold subsided. Then we had another surge, late 70s into early 1980. Look at gold outperforming. Gold was crushing equities back in the 1970s. That's what you wanted to be in. And that's what you do want to be in when you're in an extended period of inflation. So now let's look at what we have now. Here's inflation. And look at what traders think about it. There's our big move. When inflation started from 1 or 2%, beginning of 2021, right here, gold relative to the S&P is almost flat with where it was when this whole thing started. When you look at this and this, I don't see any flat. I see gold crushing the S&P. So why do you suppose that we're not seeing gold outperform the S&P 500 by any crazy, wild stretch? I mean, why wouldn't it? Inflation's runaway. Wall Street should be repositioning into gold, and the S&P, they sell off. So the ratio should be going absolutely crazy. And it's not. I mean, that to me is a big piece of evidence that inflation is not here to stay. If it was, there would be a lot more smart money pouring into gold. And I still see a lot of the gold bugs, a lot of folks out there that think gold's going to go crazy, saying, well, it's still, up 1,1800. Yeah, but it's down from over 2,000 in a market, in an environment where it should be exploding. I mean, yeah, it's outperformed the S&P a little bit, but the S&P is in a bear market. It's not really, this isn't telling me anything. So I'm just not seeing those signs of inflation. So when I put the portfolios together, inflation will not be a concern of mine. Now, I don't know if you've noticed, but the US dollar broke this multi-year downtrend back earlier in 2022 and took out this double top just more recently. I mean, the dollar's exploding to the upside. If you really thought the economy in the US was going to be so weak, inflation eats away at the dollar. Why in the heck, if you're worried about inflation and a recession, why would you be buying the dollar to this extent, to where it's breaking out and the dollar index now is at the highest level we have seen in 20 years? I don't know. I'm just not seeing it. I am going to ignore inflation. I'm going to ignore a recession, even though I think we're in one. I think the market's already priced it in. So there's no need for me to keep, checking that out and, trying to adjust portfolios based on that. All right, sector analysis, industry group analysis. I'm going to go through this kind of quick. The XLK versus the S&P 500. I mean, right here, you can see that we actually bottomed on a relative basis back in April. And the only thing I want to point out here is if you look back to the cyclical bear market at the end of 2018, do you see how technology underperformed? And then it came up and had a couple tops. And then when it finally got through the 20 and through the 50, we were off to the races on a relative basis. In early 2021, when inflation started to really spike, technology got hit really hard on a relative basis. But notice again, we came back, went through the 20, went through the 50, off to the races. This is going to be interesting to watch over the next few months. Technology relative to the S&P 500. If this keeps going up and we can break out to multi-month highs, I don't see the S&P 500 going back down, not setting new lows. Discretionary stocks really hit hard since November, really weak. But the group bottomed in May. When we went back down to a new low on the S&P in June, we actually saw relative strength. Consumer discretionary was actually performing much better than the S&P on that final low. So again, not looking great, but it's looking better than it was. Communication services still holding on to its April low, even though it had a rough day today. We'll see whether or not that holds. Industrials trending higher throughout 2022. Looks like it's starting to turn back up again. Financials, well, we're above where we were in late December, but we've been mostly trending lower in the financials this year. And, normally when rates are on the rise, which they've been most of this year, normally that's a good thing for financials. But when it's related to inflation, if it has anything to do with inflation, that's not necessarily a good thing for banks. You want rates to be going up because the economy is strengthening. That's the right reason for rates to go up, not because of inflationary concerns. So we need to see a little bit more strength in financials. I wouldn't be surprised, though, if they have a good second half of the year. Healthcare continues to be strong. And healthcare tends to do well this time of year anyway. July, August, June, July, August, these summertime months tend to be pretty good for healthcare. Consumer staples, still strong on a relative basis. Some of this is at the expense of the aggressive groups, but a lot of these groups are going up because energy and materials all of a sudden are out of favor. So that money is going in other places. Real estate, still in an uptrend, but not really doing much here the last couple of months. Utilities remain in an uptrend, but still well off the high we saw back in June. I wouldn't be surprised to see this turn back down again. But again, that's based on my secular bull market theory. There's energy, and you can see the big relative hit that energy's taken over the last 5-6 weeks. Materials, very similar, even worse, really. I'm going to try to hold on to this trend line. We're starting to turn back up. We'll see. I think we're going to get a dead cat bounce. I don't think it's going to be a whole lot of relative strength here, but we could see maybe another couple of weeks of materials doing better. But I do think ultimately inflation is gone, and I think materials on a relative basis turn back down. So those are the sectors. I mean, industry groups, I could go through them. There are 104 of them. I'm not going to spend a whole lot of time. But you can see computer services bottomed back earlier this year. This is an area in technology that's starting to show relative strength. Semiconductors, if there are a couple things giving me heartburn about the market right now and me thinking that, okay, maybe was premature on the bottom call. The two things that probably give me the most heartache is that XLY, XLP ratio that is not far from the bottom that it set back in May. I don't want to break below that. And then the other semiconductors. This is a group that normally leads bull market advances. And you can see on a relative basis, still really weak, and went down and set a new low in June that was way below the relative low in April. So semiconductors not performing well. And so that, I'm never going to get every signal to line up bullishly or bearishly. So we've got to take as many pieces of the puzzle as we can and figure out what it's telling us. Software has started to perform better, though. That's a good sign. If that continues, that would be a really big part of a potential bull market rally. Still not seeing a whole lot with the electronic equipment. Computer hardware, this is where Apple is, continues to remain pretty strong. I mean, we set a new all-time high in February. We're not really that far from it at this point. I wouldn't be surprised to see another breakout here later this year. Electrical components was strengthening. Now it's kind of rolled back over again. It is still well above where it was back in April, though, on a relative basis. Telecom equipment, this one has continued to trend lower. Still not really very bullish there. Renewable energies got through the 20-day on a relative basis. Pulled back today. We'll see whether or not maybe this last, maybe a little bit over the last week or so on a relative basis, but we'll see if we turn back up. If we can move back up through that prior high back in March, that would be really bullish for renewable energy. But I just want to go through technology because this is the biggest area of the S&P 500. It's about 28% of the S&P 500, and I'm seeing more improvement in technology while the S&P was not improving, in June. So these are some signs I think that continue to point more towards a market bottom in my view. But as we put these portfolios together, we consider all of these things and trying to come up with what is the right mix of ETFs. Now I'm going to change screens here with you for just a second. And I'm going to pull up this ETF Analyzer. So if you're new to Earnings Beats, what we do is we go through and we run a scan, usually quarterly, to try and find the best relative strength ETFs. And then once we find those and they meet certain other criteria, we want to make sure that they're fairly liquid. And once they meet the criteria we're looking for, we list them on an Excel spreadsheet, just like this. Alphabetical order. This was done back in April, but from 1 to 94. So 94 ETFs are listed here. We tell you of the top 10 holdings of each ETF, how much do they represent? So you can see if the ETF is highly concentrated, which would mean high readings here in the top 10, or highly diversified, which would mean low readings. The top 10 holdings are a very small percentage. Those would be more diversified. And then we also break down each ETF as to the 11 sectors and where the money is within those 11 sectors. So for instance, this iShares MSCI Global Minimum Volatility Global ETF, 13% is in the top 10 holdings. So it's pretty diversified. And you can see it's widely diversified among all 11 sectors. 19% technology, 13% communication services, 17% healthcare, 12% staples. We do this for every one of our ETFs. And then we have a top 10 holdings tab where if you wanted to see what that 13% was of that ETF I just told you, you can come back and you can take a look at the 10 ticker symbols and the percentages of each of those top 10 holdings to make up that 13.03% that I show right there. So you know what you own if you're going with any of these ETFs that are among the better relative strength ETFs at that time, back in April. And if you want to, know, hey, here the stock's widely diversified, or this ETF's widely diversified, but what are the 10 stocks that are, top 10 holdings? Probably even more important if you get to some of these where, you've got, I'm trying to look for some that are very diversified. Well, this HDEF X Trackers high dividend yield hedged equity ETF, 40% is in the top 10 stocks, and it's in a lot of different groups. I wonder what those 10 stocks are. HDEF, you can go right over here. They're numbered in alphabetical order going across. And there's HDEF, and here are the stocks. that make up that 40%. So here are the top 10. You might like them, you might hate them. If you hate them, obviously you probably don't want that ETF. Let me see if there are others here that are widely diversified. Well, I mean, even if you get into an ETF here like aerospace and defense, 54% in the top 10, 91% is in the industrials sector, 54% in the top 10, that's PPA. So we go over here, we scroll over to PPA. And there it is. Boeing, 7%, General Dynamics, 6.87, Northrop Grumman, 683, Lockheed Martin, 677, and so on down the line. Then you can pull up those charts and see if those individual stocks look of interest to you, and then make a decision if, you know, this is going to be a very concentrated ETF within just aerospace and defense. So it's not like I'd put 50% of my portfolio in there, but you might, you know, if you like the group and you like what's going on, you like these stocks, you might say, well, you know, maybe I do want 5 or 10% into this ETF. Again, know what you own. This is the way you know what you own. You don't know it by simply just going to your broker and saying, I want to buy the PPA. Yeah, I mean, you have no idea. Did you know that the top 10 holdings were 54%? That's pretty concentrated. Did you know? You probably knew from the name that it's mostly industrials. But what are those highly concentrated stocks? I think it's important to know those things when you're getting into ETFs. Know what you own. So that's the whole idea behind the spreadsheet. We let our members use these. And then when we do our draft, what we end up doing is we select, you know, back in April, I was being very cautious. And so here, this is a quality dividends growth fund. So I use that kind of as a core holding. It was widely diversified among all the sectors, but quality dividends, I thought that that was kind of a key for investing this year. You want to make sure you're getting dividends. That's going to be more value, a little bit more of a value slant, because many growth stocks don't even pay dividends. Most value stocks do. Here's another core dividend ETF. I'm not going into all the ownership, the top 10 and the individual stocks. I did all that back when we did the selection. But again, this is another pretty widely diversified across all 11 sectors, core dividend ETF. Another core high dividend ETF. You probably start getting a theme here. 5% small cap energy. Wanted to, you know, participate in energy for a while there. Real estate was doing well 3 months ago, so we wanted to have some real estate. Low volatility ETF, widely diversified. And look, only 3.5% in technology. Very little in the aggressive areas of the market, much more in the defensive. So 10% in there. So there was a thought process. There were themes in putting this together. It wasn't an accident that we outperformed the S&P 500 by 4 percentage points last quarter. We did it based on the themes we were seeing, based on the fact we thought we were in a cyclical bear market. And that's what we were in. So yeah, everything went down because the market went down, but we did much better than the S&P, held on to much more of our capital, even though we were fully invested because of our choices. Another value ETF, 5% went right into consumer staples ETF. Another 5% went right into healthcare. I mean, we were being very cautious. Now, about a month ago, we changed everything. Maybe a little less than a month ago. When I saw that I thought the market was bottoming and that we could see a movement more toward growth, we revised these. And this is the only time in our history we did a mid-quarter revision. But all as I did, I made it very simple. I just used the sector ETFs, 11 of them. The only one I didn't want anything to do with was utilities. I didn't like the way it was looking. But I put 35% in the technology, 16% in healthcare, 12.5% discretionary, 10% communication services. But look at the 35% technology. If we go to the top, I show this S&P 500, 28% is what was in technology. Technology made up 28% of the S&P 500 back on April 10th. And so what we ended up doing was saying, okay, we want to be a little bit more aggressive. So let's put 35% in the XLK. The XLY, put a little bit more in. XLC, a little bit more in. Industrials and financials, a little less. Healthcare, still liked healthcare, so we went a little heavier on healthcare. The defensive groups, we went a little lighter. Energy and materials, we went lighter. That was probably the biggest positive, was cutting back on energy and materials. Because where we were in energy and materials before, we were overweight. So energy, before we made this change, we were 10% almost on energy, 3% on materials. And we swapped out and cut that back, energy and materials. And energy and materials have been struggling for the last, I don't know, 5 or 6 weeks. So that was probably the best change. Also technology, because it has been holding up pretty well. And so that's part of also how we've been able to outperform. These are measured steps that we're taking with these portfolios. So next week, when we do the draft, we're going to put everything in that we're seeing at the time, and we're going to draft based on these ETFs. I do plan to try to get another one of these ETF analyzers out to everyone before the draft. It's going to be hard because I do have a golf weekend coming up this weekend. There's going to be a lot of stuff trying to get done before that event. So it's possible I might even get this done after the event. I like to have it for the event. But I have a feeling what we're going to end up doing for the next quarter is something similar to this, where we're looking at the sector ETFs and deciding how we want to weight. Because I don't want to take any huge chances going over the summer months. But at the same time, I don't want to ignore the bottoming signals I'm seeing. So I think this is a better way to maybe play it and to hopefully outperform over the next 3 months. So that's probably what we're going to be talking about next week. Anyway, that's it for all of that. That's basically the ETF Analyzer. We do provide this to members of Earnings Beats. I believe that this is annual members only. But I may be corrected. If you have any questions, you can always write into us at support@earningsbeats.com, and we'll make sure we get back to you on that. But these spreadsheets are pretty cool because you can then go in and change the allocations however you want to allocate into these various ETFs. Also, if there are ETFs that you want to include and you're not seeing them on our list because maybe they've just been underperformers, maybe you like the SMH, because it's been beaten down so bad. Well, you can always just add it in here, SMH, and put the percentages, fill this out, give it the breakdown. You can find it at Fidelity. You can find it at yahoo.com. But put the breakdown of the various groups. I mean, I can tell you semiconductors is going to be 100% technology. But whatever ETF it is, you can put in here, and it'll still include it in the calculation up here. But once you're done and you put your 100% in, like right now it's saying no error because we have 100%. If I change this to 0, if I just get rid of that, 10% communication services, now it's saying error because I've only allocated 90%. I haven't done the 100%. I need to put 10% somewhere. And so I go back in, I type that 10% back in, and now I go up and now there's no error. So there's an audit here just to make sure that you've done your allocation correctly. And then once you've put your allocation in and it totals 100%, it will go through and do the calculation of exactly how much money you're investing in each of the 11 sectors. You might do this and you might think, hey, I got a well-diversified portfolio. And you might come out and see that energy is 17% of your portfolio. And you might say, well, okay, I'm willing to take that risk. I mean, I think energy is going to bounce back. I believe inflation is going to be a problem long term. And so I want to be in energy. That's fine if that's your decision. But again, know what you own. This is how you know what you own. So you can look at this after you're done and say, yep, this is how I want to be invested. So with that, I'm pretty much done. John, I don't know if we have any questions, but I'm happy to answer any.
A couple of questions, plus, yes, that is an annual feature.
Okay.
Okay. Why does Wall Street rotate into defensive groups instead of cash during cyclical bear markets?
Well, what we're looking at is money that's invested in the stock market. That's one strategy, is to move into cash. That wouldn't show up in any of our relationships. All we're looking at is what is going into the XLY versus the XLP. So however those two are trading relative to one another is the rotation that we're looking at in terms of those two groups. Now, if you're looking at other defensive groups like utilities, again, if somebody moves into cash, or portfolio manager moves into cash, that relationship of the XLU versus the S&P 500 is not going to change, except to the extent of where that money came out of. If you took some money out of technology and that ends up sending the S&P 500 down a little bit because you're getting out of the market, then utilities relative to the market probably will go up a little bit because of that. So, I mean, it is factored in. It's just, you have to think about it in terms of the S&P 500 being the stock market only, not cash. S&P 500 doesn't have any cash in it. S&P 500 has 500 multinational companies. And then all we're doing is looking at the 11 sectors that make up the S&P 500 to see where that money is going. And it's critical. I mean, as I pointed out in the charts, I've got real-time calls that I've made for our members, real-time calls made back at Market Vision 2022, real-time calls made in my blog articles over at Stock Charts and the EB Digest. I mean, I'm not looking back and telling you what just happened. I said it at the time, but it's all based on using this relative strength information.
One thing I wanted to point out, some of these really high-tech growth funds, like the ARK fund, for example.
Mm-hmm.
If you I'm just looking at a chart, if you went back to the beginning of the year,
yeah,
and you had gone all in on that particular ETF, you've been sliced in half or more.
Probably, yeah, more than that.
It was trading at 98.08 on December 31st, and today it's at closed at 43.62.
Yeah.
Anyways, related to the previous question, somewhat, you successfully predicted beginning of the year market would drop 20% or so. In that case, why not using cash as one of the components of your portfolios?
Well, everybody's going to decide differently, as far as how much cash they want. I mean, somebody who's retired, fixed income, might look at this and might say, you know what, if it looks like we're going to go lower and they agree with me, they might say they want to be 100% cash, in which they don't even care about our portfolios. They can make that decision. I'm not making cash management decisions. I'm making decisions on, once you get into the market, if you're going to be fully invested in the stock market, where should that money potentially be invested based on current economic conditions, based on the market conditions, based on the rotation, based on everything we look at. So what I would say is each individual should look to say, all right, how much do I want in cash? And put it in cash. How much do I want in bonds? Put it in bonds. And then say, how much do I want in the stock market? And then potentially look at our portfolios based on that. But I would even say, when you're looking at our portfolios, for the most part, we have kind of gotten a little bit more defensive here in 2022 because of what I expected would be a rough year. And that's helped us versus things like ARK funds, which I was showing, John just mentioned. I mean, I can tell you right now without looking, our model portfolio has killed the ARK fund. And I look at our model portfolio as being a growth fund. But we made changes this year so that we're still invested in the market full time, and we still had some growth stocks, and we still got hit. and we underperformed the S&P 500, but not to the extent that a lot of these other growth funds did. And we're going to reposition ourselves in these portfolios when the market goes back up again, where I think our growth will, where growth stocks will once again send our model portfolio outperforming the S&P. That's my belief. I just think for the last year and a half, it's been a brutal market in terms of rotation. You have to understand that almost more than half of our existence of these portfolios have been post-pandemic now. And this is, we're all trying to figure out what's going on. We haven't had a pandemic like this in 100 years. There's no playbook out there for a pandemic. And so we literally are kind of flying by the seat of our pants. And all this rotation is making it so difficult and challenging to try to outperform the S&P 500, because one month, this area looks good. I mean, a month and a half ago, you probably would have wanted all your money in energy. Last 6 weeks, you'd have gotten clobbered if you'd had all your money in energy. That's how fast rotation keeps going back and forth. It's not just the pandemic and the demand versus supply and supply chain issues. It's also inflation. It's also the Fed. I mean, it's all these different things. The war, crude oil prices. I mean, literally, there's just so much going on and so much rotation that's been taking place. It's been a very difficult market environment. But I do think that we're going to get back to a more normal market, I would think, in 2023. 2021, I said it in Market Vision at the beginning of 2021. I said the most challenging part of 2021 was going to be rotation. And I echoed that again in 2022. I thought rotation was again going to be difficult, although I was much more bearish going into 2022. 2021, I was bullish. It was just a matter of trying to figure out what was going to lead. That was the big problem. And 2021, when inflation started kicking in, growth stocks started getting hammered, if you remember a couple of those quarters. So if you were in growth stocks, and that gets back to even ARK. I mean, you go back a couple years on the ARK funds. I mean, a lot of these growth stocks, there was the top in February 2021. ARKK was 160. They've lost 75% of the value of their funds in 15 months. I can tell you, we haven't lost 75% on model portfolio. We might have lost half. I don't know. I'd have to go back and look. Maybe we did lose a little more than half, but we're way ahead of the ARK funds. But yeah, this period right in here, especially February to May of last year. And remember, at the beginning of this session, I talked about our model ETF portfolio having one really, really bad quarter. This was it. This is when the inflation started soaring, and we were already into our model ETF portfolio. And we had one of our strategies was simply to hold these ETFs for the full 90 days. And after 90 days, we'd get out and reassess. Well, that was a really bad 90 days to be holding. The market actually kept going up. I think the S&P 500 during that period, January to April. Yeah, right here, January to April, the stock market was going up. So you go back and you look at ARK funds. Well, what the heck happened to ARK funds? Well, I can tell you what happened. Growth stocks got thrashed. And it was all the value stocks that took over leadership. So the money, it was just mass rotation. And then the reason the ARK funds started coming back up in the summer is because money rotated back to growth. So after 3 months, you think, okay, defensive groups are leading. You start reallocating toward defensive. And then all of a sudden, growth is leading again. And that was the problem throughout 2021. 2022 has been a little bit more predictable. Everything's been going down. And because it's a cyclical bear market, many of those growth names went down even faster. They continued their move to the downside. But I think we're going to reverse. I think things get better in the second half. And I believe growth is going to be probably where we want to be.
Okay. That's the end of the questions. I want to remind people again, tomorrow, the Options Max Payne webinar, one of my favorites of the month. Can't wait to see how things are looking. We'll look at, last couple of months, how things came out. Month before was spectacular. I think even last month, considering, when we look at these, Tom, quite often, we talk about options expiration and the impact going into the beginning of the following week. And I think when you take a look at that, you're going to see that once again, it was pretty, kind of a pretty amazing call. So I'm looking forward to that one. And you can come in on this. If you remember, you can sign up for a free trial, 30 days, and you'll get into all of our events over the next 30 days. We're going to have a lot of them. So certainly a great time to think about jumping in.
Yeah, I was just flipping through this as you were talking about, just kind of showing everybody how you can get there. So from our homepage, if you do want to come in for this event tomorrow, this is a members only event, but I tell you, this is, considering this a no cost trial, I can easily say that it is absolutely worth the $0 that you have to pay us for the next 30 days. But to start the no cost trial and to attend the event, you don't have to be a paid member. You can just be a no cost trial to come in for the Max Pain event tomorrow night. But if you click on this start your no cost trial from our homepage, and then just, you can go through and see some of the things that we have, that we offer our members, and then click on this join today. And then it'll go through, show you your trial, what you're getting, and then all the information that you need to put in to become a member right there at the bottom. And again, like I said earlier, we'll let you know. We always respond to our members before the 30-day trial expires, letting you know it's going to expire. We give you options. We give you some really good discounts if you want to extend for an annual membership, and then also what you're going to be charged as a monthly member if you don't do anything. But we'll make sure that we remind you of that. So anyway, if you want to come in, make sure you go through those few steps. It'll just take you a few minutes, and then you'll be prepared for tomorrow night. So that's it for me. I appreciate everybody stopping by. We're going to have a great draft next Tuesday. I hope for those of you that do like to trade ETFs, I think you'll learn a lot more at next week's event. We'll talk a little bit about some of these things we've talked about, but primarily I'll just focus on the ETF Analyzer spreadsheet and look at those, probably focus mostly on those sector ETFs would be my guess at this point. Anyhow, again, thanks for stopping by. Please make sure you join us for our Trading Places Live webinars here at Earnings Beats Mondays and Wednesdays at 9 a.m. Eastern. That's free as well. So you can just come right in. Just go to this Trading Places link. If you go right up here, Trading Places Live, click on that. Right now, you're going to see the recording, but if you sign in anywhere between, say, 8:45 and 9 in the morning on Mondays and Wednesdays, you'll see a link to just join the room. It's that simple. Just click the link and come on in. Anyway, have a great rest of your evening. Be back tomorrow with our next daily market report. Happy trading, everybody.